Hello traders, the title of the video is how do typical investors use the Elliott wave corrective waves. How do typical investors use the Elliott corrective waves? All right, this is a short tutorial to highlight how typical investors use the Elliott wave patterns. All right. So probably you already know this, but I want to touch on few points that are important for traders to understand how those typical investors use the Elliott wave, especially the corrective waves. So as you can see on this chart, I'm going to draw a line very fast. Feel free to disagree with my wave count. First wave, second wave, is it coming to the beginning? Almost, but not. And then we say third wave. I'm on the monthly chart, and the financial instrument that we are looking at is a tetraphase pharmaceutical incorporation. Tetraphase sounds a bit like French. Tetraphase pharmaceutical incorporation. So we have 5 waves. So those typical investors. So in fact, most of them, may not know too much about Elliott wave. They will say, the market was going up before, this stock was going up for some time, and then they see the sharp correction. But though they are typical investors, they are a little bit smart because they know that after the sharp correction, probably the market was overbought. They say, well, this market is now overbought, and we are likely to see a crash or blah, blah, blah. So this is the sharp correction. And those typical investors know about the sharp correction. So they see the sharp correction. And over the year, they have been trading the sharp correction and they lost money. And they remember it's not when one should not catch what we call the falling knife. So sharp move, that's not the best time to time the market. So you will hear some of those investors talking about television and say that my only problem is that it's the market timing. So they are fundamental traders. They understand that they should buy the financial instrument and they should sell the financial instrument. But the only problem that those typical investors are facing, they don't know how to time the market. But over the year, they have more experience and they know that after the sharp correction, they shouldn't buy straight away and they should wait for the bounce up. So they know the pattern, which is the 1, 2, 3 pattern, Elliott wave, zigzag. So sharp correction. This is what we call the dead cat bounce. You see this bounce up. This is what we call dead cat bounce. And they see like this. So once they see like this, and price going a little bit horizontal, they are now ready, to open their wallet, so to speak, and try to buy the financial instrument. But hold on a second. Hold on a second. So what are they looking? So the thing is like this. I want to go very fast, because I want this one to be a very short video that anybody can watch on the bus, on the tube, all right, in your bathroom, very fast. You can watch this video, So here it is. So they're looking for something like this: 1, 2, 3, 4, 5. A trending fell, a sharp correction, and they know the pattern. And we are talking here about corrective wave, and they do care about this typical corrective wave: a sharp correction, a bounce, and then a price pull back like this: 1, 2, 3. And after that, they want to buy and they look at the fundamental. But you have to understand those typical investors are fundamental traders. So if you are watching this video, you are a technical trader and you want to follow or apply the same strategy, you want to use Google for now, you want to perform Google Assist test, and you want to do a thorough fundamental analysis, because you will be competing with the best fundamental traders out there, best fundamental investors out there, So once they see this pattern, which they know very well, so they go around looking at different charts, especially on the monthly chart. They see that this trending first, 1, 2, 3, and they see the sharp move, the bounce, and this one. So now they go, after they see that, they go now and do their fundamental analysis, a thorough, do diligence, and once they are satisfied, they keep buying the stock. They keep buying, and hold. This is how typical investors use the corrective wave. But one thing I want you to remember in this tutorial is that this pattern, this is the corrective wave, the 1, 2, 3, the zigzag pattern. When we have the first part of the zigzag pattern is too fast, okay, too quick and too fast, a sharp move down. That's critical for those typical investors. It must be a sharp move down, a sharp, critical, sharp move down, then the bounce, okay, then the bounce, okay, and then the third move down. That's what they are looking for. A sharp correction is critical. Now, you may say, John, you are repeating yourself because it's so important. That's why I'm banging on it, because if you forget that it must be sharp, then you are doing something else, okay? So here it is. Okay, now it's ready. Okay. Now, like this talk, this is the pattern that typical investors are looking for. So you want to buy and hold, okay? So, but there are more to this. Then they go and do their fundamental analysis. They are satisfied, they keep buying. But another challenge that those typical investors are facing, they don't know about what we call the trading triangle. So, for instance, all right, so they see it, okay, the pattern is completed. They recognize that corrective waves, sharp correction, bounce, and another move down, and then the price becoming a bit flat, low volatility in place. Now, fundamentals are solid, all right? They consider the financial instrument as oversold, that the correction has finished, they want to buy, okay? But a correction can be prolonged for some time. You need to understand that. And also, a correction can become a complex. It does not mean because one has seen this particular pattern that definitely we're going to have a new cycle. The financial instrument may be in consolidation for many years, or you see here for many years. So in fact, it was here since 2016, about 1 year to come now. Maybe stuck here, consolidating between $11.73 and $4. You never know. Maybe prolonged for some time, but get the point. All right. So apart from timing the market, which they try to improve by using this particular pattern, they face another challenge because they don't know about the market, the trading triangle. So if you, as an Elliott wave trader, you want to follow suit, you want to be a little bit smarter. So you know how to time the market, you recognize the pattern, you know about it, a sharp correction, a bounce, a pullback, fundamental analysis, a thorough due diligence, and then now you need to apply the trading drill. The market first, the sector, before the individual financial instrument, without ignoring the economy news, the fundamentals, okay, and the market leaders. Because if you start buying a stock, but the market, the S&P 500 has peaked and is about to become bearish, that's the wrong time to time the market. You want to buy and hold only when the market itself is turning from bearish to bullish, or the market itself is about to go up. This is very, very another acid test one should perform if one wants to be a smart investor. So timing the market is very important for fundamental trading. If they can work on it and improve it, that's very important. And one of the tools that they can use is the trading triangle. All right, so I want it to be very short. I hope you like this video. Let me know how you found it, okay? And put your comment and your suggestion in the comment section. And in due course, I will be recording another video to answer your specific question. This is the end of the tutorial, talking about how do typical investors use the Elliott Corrective waves. Happy trading to you all, and speak to you soon.